This Chapter 2 examines in detail the quantitative scoring factors applied by Moody's in their approach to the sector and how these are ultimately bundled together to derive a first estimate of the carrier's credit rating. We focus in this chapter on the Moody's approach only, since it allows us to estimate a specific rating within a notch or two from the actual one, provided we have the correct inputs and apply the suggested methodology as instructed. The Moody's 1 document identifies 4 broad rating factors that drive the quantitative part of its airline assessments, which are broken down into a further 11 sub-factors that carry each a specified weighting in the scoring process. The 4 key risk factors are cost structure, market conditions, financial policies, and financial metrics. And these are broken down as follows. Under cost structure, fleet age carries a weighting of 9%, labor efficiency 4%, fuel hedging 9%, and EBITDA margin 9% again. These aggregate to 31%, meaning in effect that considerations of cost structure represent around 1/3 of the aggregate quantitative score, not surprising for a commoditized business like this one. Within market conditions, Moody's specifies only geographic diversity, attributing to it a weighting of 12%, which becomes by default the aggregate weighting of the market conditions category. Under financial policies, cash liquidity receives a 7% weighting, and degree of encumbered assets another 12%, bringing the total to 19% for the category as a whole. Finally, under financial metrics, EBIT to interest receives a 10% weighting, RCF to net debt 12%, debt to EBITDA 10%, and debt to capital 6%, which in aggregate mean that the financial metrics category becomes the largest in importance at 38% of the total. We now turn to the determination of the rating earned by the carrier in each subcategory. Beginning with fleet age, Moody's describes the subfactor as a proxy for operating efficiency, substituting for operating and maintenance costs, which, in its view, are not transparently and consistently disclosed by the airlines. The advantages of a young fleet include lower maintenance in the near term, covered by the manufacturer warranty in some instances, greater fuel efficiency, and a closer match between the aircraft and the near-term needs of the carrier as opposed to older fleets. The table appearing now links the average fleet age to one of 7 broad ratings categories, from AAA to CAA, and is self-explanatory. So a carrier whose average fleet age is 4 years is classified in the single A category with regard to this specific subfactor, which, we remind you, has a 9% weighting within the total. Note that only the broad rating grades are used for this purpose. In other words, without the suffixes 1, 2, and 3 that are normally added at the end of an issuer's final credit rating from Moody's. So, for example, the 4-year fleet earns its carrier the single A denomination without specifying if it is A1, A2, or A3. Moody's also mentions with regard to fleet composition a number of additional considerations that are not included in the fleet age measure, but are considered in the final ratings decision. These include fleet homogeneity, which reduces maintenance costs, since it requires fewer qualifications on the part of the maintenance staff and lower inventory of aircraft parts, and the manner in which the fleet is financed, i.e. whether through ownership, financial leases, operating leases, or so-called short-term wet leases, in which the airline leases the aircraft and its crew as well. We jump ahead of ourselves briefly to show next what Moody's would do with the single A rating obtained by our carrier in the fleet age category. In short, the rating agency associates with each subcategory rating a numerical value based on the grid appearing now, where you will note that a high rating translates into a low numeric, and vice versa. The single A for our carrier therefore translates into a numerical value of 6, a number we will use at the end of this process in combination with the 9% weighting for this category to derive the final weighted average score and hence the final credit rating for the issuer. Our remaining task before we proceed to this final calculation is to summarize the scoring methodology for each of the 10 remaining subfactors on our original list. Next on this list is the subfactor labor efficiency, for which Moody specifies the ratio of revenue passenger kilometers, or RPK, flown to full-time equivalent personnel. Moody's considers this measure a good indicator of the labor cost of the airline, in other words, of the efficiency with which the airline uses its staff and the number of paying passengers it generates from those staff. Moody's recognizes two limitations of this measure. One, it does not take into account other non-passenger carrying businesses, which can be quite sizable for certain airlines, such as travel, catering, maintenance, and freight. And two, it unfairly penalizes airlines with mostly short-haul flights, which require, as mentioned previously, more ground staff for baggage handling, check-in, and ticketing than longer ones. The agency feels that these inaccuracies are partly compensated in the overall measurement of the EBITDA margin, to which we will come in a moment. The table appearing now converts the RPK-based measure into a broad ratings category just as before, with a ratio above 4.5 million translating into a AAA rating, a ratio below 2 million into a CAA rating, and all ratios in between earning a rating between these two extremes. We continue in the same manner, but now move a little faster since the general idea should have become clear. The third subfactor in the cost structure category is fuel hedging, which is measured simply by the percentage of fuel purchases over the next 12 months whose price risk the airline has hedged. Despite the absence of adequate substitutes for many flights, especially the long hauls, most airlines are not comfortable passing all fuel price increases through to their customers, partly for competitive reasons, especially from the low-cost carriers, partly because elasticity of demand, while substantial for business travelers and some non-business travelers, is not unlimited, and partly because the passenger has often paid for the ticket before the airline purchases the fuel in question. The agency recognizes that few airlines hedge their fuel purchases much beyond 1 year due to cost considerations, illiquidity of hedging instruments, counterparty risk limits, and the fear of finding themselves locked into high prices just before a substantial correction that lasts for several years. Moody's also acknowledges that hedging programs may not be effective under all circumstances, since the airline does not know with certainty the quantity of fuel it is likely to use going forward, and since fuel hedging is often implemented via proxies such as crude oil and heating oil, which boast substantially greater market depth. Nonetheless, with fuel sometimes representing up to 40% of total airline costs, the agency's view is that, quote-unquote, financially conservative airlines will have a high proportion of their fuel consumption costs hedged. We make two important observations with regard to this subfactor. One, the rating agency does not specify clearly what it considers an adequate hedge for purposes of this criterion, mentioning briefly options, collars, and futures without further detail. No distinction thus is made between call options or caps with strikes close to the current spot and ones with strikes much further away, the latter, of course, being much cheaper but offering protection of a poorer quality. Observation 2. The rating agency says nothing about how it would view various kinds of structured derivatives, but presumably would frown upon hedges, common in certain regions and industries, that offer some protection in most scenarios, while exposing the user to potentially large losses in a small subset of the remaining scenarios. We point out finally, and perhaps most strikingly, that this is the only Moody's industry rating methodology, among more than 40 in total, for which hedging of any kind is specifically included among the rated subfactors. This is not to say that Moody's places no value on hedging commodity, FX, and interest rate risks outside of the airline industry. Indeed, for many industries, volatility of FX rates and commodity prices are specifically cited among the principal risks to which the issuers are exposed. And for financial institutions, especially banks and insurance companies, the rating agency scrutinizes very carefully the exposure to interest rate levels and volatilities. But in none of these other industries does hedging receive a specific weighting in its own right. The Moody's table appearing now translates the hedging level as a percentage of the next 12 months of fuel needs into one of the usual 7 broad rating categories. Last on the list for the cost structure category is the EBITDA margin, defined as EBITDA over revenue. Moody's views this measure as the one that, in some sense, fills any gaps left by the previous 3, which account for most of the individual elements in an airline's operating costs, namely maintenance, personnel, and fuel costs. In contrast to the other 3 subfactors, EBITDA margin captures the relationship between the revenue gained from all airline revenue generating activities, passenger and non-passenger related, and the costs of operations. The table appearing now converts once again this ratio into a broad ratings category and is again self-explanatory. One point to emphasize here, and throughout the discussion of financial metrics, is that Moody's calculation of the various ratios is not solely predicated on the accounting definitions under US GAAP or IFRS. Often Moody's restates a number of financial measures to reflect instances in which, in its opinion, generally accepted accounting principles fail to capture the true economic reality of the issuer's financial condition. These restatements for non-financial corporations are described in a document entitled Moody's Approach to Global Standard Adjustments in the Analysis of Financial Statements for Non-Financial Corporations, dated December 21, 2011, which we will call Moody's 2 from here on. A separate module analyzes these adjustments in depth, but the ones that most commonly apply to airlines are the treatment of leases, off-balance sheet activities, and pension obligations. These often give rise to a number of obligations that are debt-like in all relevant ways, but are accounted for in another manner under generally accepted accounting principles. Where Moody's finds it necessary to enhance the analytical value of the GAAP-based financial statements, it imposes its own recharacterization of the instrument or arrangement in question, often resulting in a change in the entity's debt level for purposes of its ratio analysis, and with that in a number of the key financial metrics. We will see in Chapter 4, when analyzing the specific financials of the designated airline, how the operating leases of the company are subjected to this treatment. We turn now to the second rating factor, market conditions, which you will recall includes only one subfactor, geographic diversity. Moody's views the number of markets in which an airline competes as a key source of rating analysis, since otherwise the entire cash flow of a carrier might be captive to the dynamics of a single market or economy, especially when the air industry is subject to an exogenous event such as 9/11. Moody's measures geographic diversity as the number of continents the airline serves and the proportion of revenue generated from each, using these two simple components of the measure because they are easy to obtain for almost all carriers. The agency states that, quote, many other competitive market factors are considered sensitive by the operators and thus cannot consistently be available for comparison in this methodology. The table appearing now associates a broad rating category with the airline's geographic diversification, in each case as specifically defined in the text immediately underneath the rating category. You will note how difficult it is for any airline to reach the AAA or AA classifications. And you will recognize that a majority of airlines in the world on this measure are unlikely even to make the investment grade category, given the typical dependence on the continent in which their home base is located. The third rating factor, financial policies, includes, you will recall, two subfactors, cash liquidity and degree of encumbered assets. The first of these, cash liquidity, is crucial in a business that is so volatile, and where many external factors create sudden and unexpected dips in passenger numbers, and therefore revenue, examples being 9/11 and the SARS epidemic in Asia. As we mentioned before, it helps a great deal that passengers make upfront payment, supporting higher cash balances than other industries which receive payment well after service delivery and cost outlay. The table appearing now converts the specified ratio of cash and cash equivalents to unadjusted gross debt into one of the 7 broad ratings categories. The reference to gross debt means that the aggregate amount of debts is used, rather than the common measure of net debt, which offsets a company's debt against its cash balances. The word unadjusted here means that operating leases are ignored and not included in the aggregate debt load, in contrast with other ratios, as we shall see shortly. Unencumbered assets are of critical importance to an airline's credit rating, since they enhance substantially the airline's financial flexibility, whether via their sale or via their pledge as security against new loans. An airline with a high percentage of secured debt reduces its future financial flexibility for 2 reasons. Few assets remain to be sold or pledged against new financing, and unsecured loans become even harder to obtain given the low recovery in default creditors are likely to achieve if most valuable assets are subject to the prior claims of secured creditors. Moody's recognizes that in many instances in Europe and parts of Asia, creditors have continued to support domestic airlines despite a low level of unencumbered assets. In such cases, the ratings committee may adjust by up to 1 rating band the score the airline would otherwise achieve in this subcategory. Examples of this are the 2 principal Japanese airlines, which received support from government-related institutions when arm's-length borrowings were no longer available. The table appearing now converts the ratio of total secured debt to tangible assets into one of the 7 broad rating categories. It is striking to observe that as soon as this ratio exceeds 20%, the category rating drops below investment grade, and above 30%, it reaches CAA. Moody's does not comment on why it is so conservative on this measure, but we think it reflects the agency's view that when times are tough and financing is scarce, property values are likely to have fallen substantially, so in effect, large conservative haircuts are necessary in the estimation of asset values against which financing may be obtained. Moody's also mentions that its evaluation of an airline's liquidity, in addition to the 2 sub-factors specifically listed, includes any access the company has to unrestricted, undrawn lines from banks, and the existence of route allocations and landing slots that can be sold for substantial sums if the airline is in financial trouble. The last of the rating categories includes the 4 financial metrics, in a sense representing the core of the agency's traditional approach to the evaluation of credit risk. These permit an assessment of airline financial strength on an absolute basis and facilitate comparisons across different airlines and across different time periods. They also allow for comparisons across different industries and promote ratings consistency, although many instances exist in which ratio comparisons across industries would be entirely invalid, such as the leverage ratios of banks and investment banks, which would not be permissible in any other industry. The table appearing now shows how Moody's converts each of the 4 metrics in question into one of the 7 broad rating categories. the reference to RCF, meaning retained cash flow, a term defined by Moody's to mean cash flow from operations minus dividends. We need to specify that, as mentioned once before, these metrics are not extracted solely from traditional GAAP measures, but are restated to reflect the adjustments required by Moody's as described in the document Moody's 2. Moody's points out that only one of these four factors uses net debt rather than gross debt, explaining that it generally does not rely on net debt metrics, since cash can be used for operating costs or capital expenditures or distributed to shareholders, so it cannot be assumed to be available for debt retirement. This is despite the fact, acknowledged by Moody's, that airlines in particular often have a policy to hold a certain amount of cash as a buffer for dealing with external shocks, in a sense diminishing the likelihood that this cash could be used for these other purposes. Once the determination of the individual ratings for each of the 11 subcategories is complete, the remaining steps in the quantitative part of the credit analysis are straightforward. Step 1 is to combine the individual subcategory ratings with their individual weights to obtain an overall weighted average score for the company as a whole, again by means of the table you saw at the beginning of this chapter, reproduced here for your convenience. So remembering that fuel hedging has a 9% weighting versus 12% for geographic diversity, an airline that is ranked in the AA category, worth 3 points, for fuel hedging, but in the BA category, worth 12 points for geographic diversity, would multiply the 3 points by 9% and the 12 points by 12%, and so on for the remaining 9 subfactors to reach its aggregate weighted average score. This will become clearer in the final chapter when we perform a specific evaluation for our designated carrier. All that remains is to produce the final table from Moody's 1, which converts the weighted average score into the overall rating, at least with regard to the purely quantitative part of the analysis. This table appears now, where for the first time you will note the presence of the numeric suffixes, enabling the rating agency to differentiate more finely than heretofore within its usual 7 broad rating categories. As we have mentioned, Moody's currently rates 17 airlines using the methodology described in the Moody's 1 document, with final senior unsecured ratings ranging from Baa1 to Caa2. Moody's provides the individual subcategory ratings for each of these 17 carriers and some commentary that is worth analyzing. The table appearing now lists in the first column the names of the individual carriers, with their senior unsecured rating appearing in the second column. Note that only 4 of these 17 carriers were in the investment grade category when this document was published, and even some of those have been downgraded to speculative grade since. The remaining 4 columns show the individual ratings for each subfactor in the cost structure category. Moody's makes the following observations about some of the outliers. JetBlue and AirTran have particularly young fleets, since both are rapidly expanding airlines that have purchased new aircraft recently to facilitate this expansion. Continental's relatively high labor productivity stems in large part from their subcontracting of their regional feeder operations to Continental Express, a separate company. Southwest, normally an avid user of fuel hedges, has brought its hedged percentage down to 10% of forward requirements, following the substantial decline in oil prices. Qantas, on the other hand, has 97% of its 12-month forward needs hedged at a worst-case price of $110 per barrel, and has used structured derivatives in its strategy which allow it to participate in 73% of any decline in prices. The very challenging market conditions as of the time of this report had resulted in several negative outliers for EBITDA margin. Nonetheless, the rating agency takes a through-the-cycle approach, which assumes a certain reversion to the longer-term mean as market conditions improve. All these comments from Moody's are summarized on this slide here for your ease of reference. This next table lists again the names and senior unsecured ratings for each carrier, but this time shows the rating for the geographic diversity category. It is not at all surprising that the strictly domestic Southwest Airlines is rated, with regard to this subcategory, far below its overall rating of Baa1. Nor perhaps is it surprising that not one U.S. airline makes it to investment grade here. Moody's comments with respect to Southwest that the benefits of its domestic strategy are captured elsewhere, notably in its low cost per available seat mile due to the operation of a single aircraft type and its high utilization point-to-point route structure. The first two columns in this next table are the same as before, but the third and fourth columns show the subcategory ratings for the financial policies subfactors. Of note here are the large cash reserves relative to debt load for Air New Zealand and Lufthansa, the latter in particular having seen its cash reserves boosted by the consolidation of the former Swiss Air. The opposite is true of Southwest and All Nippon Airways, especially when compared to their overall rating. Moody's comments in this regard that All Nippon has strong unused banking lines and other forms of liquidity which are not incorporated in this subfactor. Moody's also notes that British Airways is a negative outlier in the second subcategory since it has a large amount of secured debt and finance leases which it has used for aircraft purchases. This final table shows the ratings for the financial metrics subfactors. Again, All Nippon stands out for an especially large gap between its score on the last three subfactors and its investment grade rating, part of which is explained away once again by the availability to it of undrawn committed bank lines. Lufthansa's RCF to net debt metric benefits from the strong cash balances we mentioned previously. And once again, this page summarizes our previous remarks for your benefit. We complete this chapter by examining the other rating considerations cited by Moody's in the document Moody's 1, but not explicitly incorporated in the 11 subfactors we have been analyzing. Moody's acknowledges a trade-off between simplicity that enhances transparency and greater complexity that would enable its grids to map more closely to actual ratings. It also emphasizes that its ratings incorporate expectations for future performance, while the financial information used to illustrate the mapping process is mainly historical. Important factors left out from the 11 rating subfactors include quality and experience of management, corporate governance, and quality of financial reporting and disclosure. Because the assessment of these factors is highly subjective, and ranking them by rating category in a grid would suggest more precision than is realistic. Moody's comments finally on the significance of an airline's dominance in its key market. The application of this factor to airlines is becoming increasingly rare, given deregulation, but it continues to be difficult in many cases to start operations in a new country or region, given the necessary government approvals, landing rights, marketing campaigns, and possible purchase of new aircraft. Accordingly, in setting the final rating for an airline, Moody's takes account of the following considerations to determine whether a carrier enjoys what it calls core market dominance. 1. Whether the carrier has a monopoly or strong position within a duopoly, which permits the carrier to improve yield and enhance revenue. 2. Whether low-cost carriers have entered or are likely to enter the market, particularly given the common strategy by LCCs to build market share by offering very cheap fares. And 3. The presence of other barriers to entry, such as government policies prohibiting some airlines from certain routes, including the common prohibition on intra-domestic routes for non-domestic airlines. Moody's regards an airline as dominant in its core market if it has more than 50% of passengers in that market. Examples include Qantas, with a 65% share of the Australian domestic market, and Air New Zealand, with more than 80% of the domestic market in New Zealand. Near misses include the two main Japanese airlines, each with more than 45% of the domestic Japanese market. This completes Chapter 2 and Part 1 of this module.